Welcome everybody. This is the nope, not Thursday, it's Saturday morning Viper trading webinar. Hold on, excuse me. Sorry about that. If you're here to learn about trading the futures markets using the Viper tools, you're in the right place. Today's topic is Detailed Midband Trades Part 2. This is a follow-on to the Part 1 webinar we had on last Thursday evening. First, we got to knock out our standard disclaimer. Let's go ahead and take care of that real quick. All communications from Viper Trading Systems are for educational purposes only. Futures trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody here does know that you do trade at your own sole discretion. All right, good. So let's start off with the gold chart. Excuse me, over on screen 1. And here's how I'd like to do a quick refresher. A lot of people in here still, this is the tail end of what we called last week was our fall open house. So I know there's a lot of folks in here who are still relatively new and might be looking at some of these charts here for the first time. So you might not, be clear as to what you're looking at. But we trade futures instruments intraday, so we look for intraday volatility. We rarely, if ever, hold overnight positions, so this is not a long-term or position or swing trading type program here. We're connected to a data feed to our broker, and if the data feed gives us instrument feeds, so we trade YM. We'll look at all these charts today. Mini Dow, Russell. We just rolled to the December contracts on the equities. Some of us trade the NASDAQ. It's a little bit of a high flyer. I'll actually show a NASDAQ chart today. You'll see what I'm talking about. Gold, we're going to look at gold right now. The E-mini S&P. A little bit of a slower mover, but you can get some volatility out of that. And then, of course, crude oil. And here's the currencies. So if you had a data feed that was coming in that didn't have any indicators connected to it, you would just see bars going up and down on your chart. Very difficult to trade, very hard to see what to do. And so what we did is we invented these indicators. So there's background colors, red and green, and this sort of an intermediate color. And bar colors, blue, red, and yellow. Of course, you see that. We have the swing levels. We have predictors. Toggle those on and off. Those show real-time swing levels. They're kind of these little bubbly looking things. The power meters are the trends. And then, of course, the most prominent thing on the chart is these bands. The thick line in the middle, of course, is called the midband. Everybody knows that. If you're looking at it for the first time, that's what that is. We call this the midband. And hence, the bulk of the discussion of our trading today is going to be centered around the midband. And let me blow this up a little bit. So you can see the numbering of the band starts with 1 at the bottom. So 1, 2, 3, 4, mid-band, 5, 6, 7, 8. And then if you notice at the top of band 2, there is a thin red line. That's called line 2, mid-band. And then at the top of band 6, you have a thin green line called line 6. So just recapping what we learned last Thursday is a lot of our trades are going to be centered around line 2, midband, and line 6. So you're going to find that these 3 lines or levels, if you will, feature prominently in how we take trades. So in that sense, it gives us a framework in which to trade. Because if we didn't have a framework to trade, we would just sort of be, randomly looking at spots to get in and drawing some lines here and there and hoping we're getting things right. Whereas with the bands, it's pretty clear what we want to do. And I don't want to say it makes trading easier, but it sure makes it a heck of a lot easier to see what to do and where to take the trades. So one of the most important fundamental things to understand about financial markets is this, especially when you're actively trading as we are, that there's this notion of thrust and retracement. Let's do a couple together. When a market goes, sorry about that, it's a tickle in my throat, hold on. A little cold tea here this morning. Um, so when a market goes into a trending direction, the first thing that generally occurs is you're going to get what's called a thrust in the trending direction. In this case, we're looking at gold, and this would have been yesterday, yeah, Friday morning. Okay, let's give you a quick orientation here. This is midnight Pacific on Friday morning. Most of you know, of course, this is the midnight here. Adjust that to your local time zone. Is the end of the Asian session. So, you know, the large banks and financial institutions in Hong Kong, Singapore, and what have you are trading up to here from 5 o'clock Pacific. So here's the end of the session here in the States, and then this would have been the Asian session. So looking back over here, you can see that into the Asian session that gold had gone into an uptrend. So this would have been the thrust in the Asian session. We get a little pullback here, nothing, peaks up here, and then we get, just to round this out a little bit, this is actually the beginning of the European session. Asian session, European session, beginning. And so at that time, gold was in an uptrend. Now, we are what you call retracement traders. Pullbacks is what we trade. So we identify the trend direction, if there is one, and then we patiently wait for pullbacks to occur. So in an uptrend, of course, just to recap our discussions from Thursday, in an uptrend, we're looking for pullbacks into support to get long. So we're buying support in uptrends. So here's a good example right here, where we get a retracement, and the wick of that candle touches just above the midband. So this is an example of a long trade right here. So you would be buying. Folks who were trading this at that time would be buying this gold at this time on this bounce. Okay? We'll talk about the details of how to enter it. Right now, I'm just sort of talking at a 20,000 foot conceptual level. So everybody just gets a handle on what we're doing here. Okay? Now, you can tell that as the gold market worked into the European session on Friday, you can see that there was a succession of slightly lower highs and lower lows. So you get a fresh push up to a high here. Profit taking occurs for those who were long from lower levels, from anywhere in lower levels. Profit taking, of course, what that is. And so you get a series of retracements. Now, you might say, well, you know, are all these bounces long trades, Charles? And the answer is yes. Long trade here, long trade here. Now, they didn't give you very much. Clearly, these bounces were just little scalpies. You know, maybe you get 5 ticks if you're lucky, depending on how you got in them. But technically speaking, yes, those are long trades. How about this? Let me ask the question and make sure everybody's awake. Is this still a long trade, or is that a short trade? Here, we'll do a yes/no question. Is this little area right here still a long trade or not? So yes or no. What say you, team? This little box I just drew. Is this still a long trade, yes or no, on this chart on gold? This would have been right about 3:30 a.m. Pacific time on Friday morning. Let me take these off here so it doesn't confuse anybody. This little box right here. Is that still a long trade, or should we be shorting there? It's red bars, right? Red bars. It's not a short trade. Right, good. Everybody, Todd, oh, hey, Mario, I didn't see you come in. Kathy, hi, Kathy. Welcome. People still coming in. Don't worry, we're still in the early stages of starting. You haven't. Oh, and this is recorded, and we're going to send it out to everybody. So if you got to leave early, don't worry about it. We got you covered. We'll send out the recording when it renders in about an hour, so don't panic. Yeah, this is still a long trade. Exactly, that's a long trade. So here's let's talk about the concept of the depth of retracement. So since you say we're retracement traders, how do we know what type of trade we're in at any given time? So here's a good way to look at it, and this is the simplest way I can put this, okay? In an uptrend, if a retracement comes into this area right here and bounces, that is called a shallow retracement. And so our requirements are, and most of you know this, of course, is that it's got to close below the stealth line, the green sneaky snake line in an uptrend, right? And line 6, the green thin line. When a market comes back in an uptrend and retraces into here and bounces, this is said to be a shallow retracement trade, okay? Now, if a market comes into the bands that surround the mid-band, right here, like this, that is said to be a mid-band trade. So sometimes they'll sit right here. Sometimes they'll actually sit physically right on the mid-band, like these bars right here. And some bars will come down into band number 4, right here, this little box underneath the mid-band. Now, if a market comes down deeper in an uptrend, and it dips down into what would be above line 2, into band 3, anywhere in this area right here, this is said to be a deep retracement in an uptrend. So in our question there, is that still a legitimate long trade? The answer is yes. Yes, it is. Now, let's talk about when a trend change occurs. And I'm going to ask it in this way. Would you say that the trend changed on this chart on gold at this point, we'll call it A, or at this point, we'll call it B? Where did the trend change on gold on this chart from up to down? Would it be the circle A right here, or would it be the circle B right here? We're looking at trend changes. Now, I'll just help you out. It did change, so it's one of those two. You can pick A or B. It's one of those two is correct. Just which one is it? Trend change on gold, circle A. Trend change, this one right here. Trend change on B, circle B. You only got two choices. Just type in an A or B. Boop, boop. Cast your vote. Give you 3 more seconds. Just type in a letter, A or B. Trend change on gold. Right here or right here? 2 seconds. Cast your vote. All right, time's up. The correct answer is B, and here's why. For a couple of reasons. Now, you could say, well, the way I see it, Charles, is I could have drawn a downtrend line like this, and clearly you could see with the succession of these lower highs that it was kissing it and rolling every time. So by the time this kissed and rolled, it was pretty clear it was heading down. Now, I would agree with that argument. I don't think anybody can deny that if you put a downtrend line, you can definitely see that the uptrend was waning and starting to fail. However, that swing was the tail end of the last long trade from this bounce off of support. And at the time this occurred, you did not know whether mid-band would hold and it would continue its ascent. So it's not A, okay? It's not A. Now, when this market thrusts down through support to a lower low here, the background turns red. The bars are predominantly red. And it would be at this point right here that you have a trend change. Okay? Now, some people could argue that you could have gotten a long down here in what's called a super deep retracement, or even a phantom, you could call it, and that you could have traded it up to here. And that is possible. And could you have shorted a rollover up here? Yes. Now, just to make sure everybody's still awake, by our definition, this is a yes-no question, is this last box I drew right here a mid-band trade, yes or no? This box right here I just drew, just a yes-no question. I got a lot of trades to cover, so all these questions I'm doing, I'm only going to give you 5 seconds to answer. Because you should start to, as time goes on, when you hear these questions, you should just look at it and say yes, no, yes, no. It should be like a subconscious thing, not really needing to think a lot about it. I see lots of questions coming in quickly in response to the question, answers coming in the question. 2 seconds. Legitimate, is this a mid-band trade, yes or no? Time's up. Yes. Okay, let's look back at our definition. Some of you are still, I don't know, maybe not seeing it. When we're in a trend, let's say an uptrend, just to recap, in an uptrend, when a market or bars come into this band right here, which is number 5, or what, say 1, 2, 3, 4, 5, 6, 6. This is a shallow retracement. Mid-band trades are framed by the bands around the mid-band, like such. And a deep retracement is down here. We see that. Now, when you're in a downtrend, the opposite is true, right? So in a downtrend, a shallow retracement would come into here, right? Just above line 2. We got to close above line 2 in stealth. And in the case of the shorts, your mid-band trade would more or less be located somewhere in here. The bands surrounding the mid-band, yes, for shorts. And in the case of a downtrend, a deep retracement would occur up in here. See? That would be a deep retracement in a downtrend. So the question on the table was, is this a legitimate short trade called a mid-band trade? And the answer is yes, because you're within the bands above and below the mid-band. So that's what constitutes a mid-band trade. So in a downtrend, this is deep, right? This is shallow, and this is mid-band. In an uptrend, the opposite is true, right? This is shallow, this is mid-band, this is deep. So just think of it, depending on what trend you're in, just conceptually speaking, that's how we take it, how and where we take trades. So let's go ahead and move on with gold, and we'll look at a couple more, and then we'll start popping some other charts up here, okay? Everybody on board with this? I wanted to just take a few minutes and just really sort of condense this down into so you can just crystally clear see where these trades are occurring and how and where you should take them. Okay, good. I see some yeses. Perfect. All right. So now here is another thrust in the down direction. And you get a retracement. We'll just do a few of these together, and then we'll move on to some other charts where these trades will be a little more complicated. So let's do some easy ones first. Here's a pullback into this area right here. Is this a mid-band short? Yes or no? That box right there. Is this a mid-band short? Yes or no? 5 seconds on the clock. Cast your vote. Remember our definitions up here, okay? Keep those in mind when you start looking at trades on the chart. When you start looking at where the bars are going, just keep these squares and rectangles in your mind, right? In your mind's eye, as you look at the market move. 2 seconds. Legitimate short trade, yes or no, on this box right here. 1 second. Cast your vote, yes or no. Time's up. Yes. So remember our definition in over here for shorts in a downtrend. This is in the band just underneath the mid-band and therefore is a mid-band trade. Yes. By the way, this should help too when you're in the live trading room and you see markets moving around. You're looking at your own charts, right? You're putting support resistance lines. You're looking to take trades. Gary says something about, resistance here. I say something about support over there. I will box that in. I will take if it comes to the mid-band and rolls, I will take a short. And so we might be saying those words when the market might be over here somewhere. So the reason we say that is that if you are in a downtrend, as gold was on Friday morning, and you're looking for retracements, the logical place to go is obviously the mid-band. Right here, that's in the mid-band being defined as not only the mid-band itself, physically the large thick mid-band itself, but the band surrounding the mid-band like that, right? I think we did call that one, Jack. I think you're right. I think let's see, this would have been 6:30. Yeah, I do believe we called and took that short on gold in the live room. Yes, I do believe you're correct. In fact, I think I took that one, as I recall. All right, let's look at a couple other ones. Let's look at a couple other ones real quick, and then let's get on to we'll cast some votes for what instrument to look at next. All right, now let me ask a different question. Is this a legitimate short trade, yes or no? This box right here. By our definition, is that a legitimate short trade, yes or no? 5 seconds on the clock. Just take a look at it. Remember, it's a function of the positioning of the bars in the trend is what defines our trades, yes? So think of our criteria, and does it fit? If it fits, then obviously it would be a yes answer, and if it doesn't fit, there's a no. Minaj asking about placement of initial stops. The default on that is usually 12 ticks, Minaj. However, you can adjust that if you're taking shorts in a trend, as this box is right here, and leave the 12 tick, or you can put it near support or resistance. So 12 is kind of the normal stop. In fact, next Thursday, I'm going to have a whole webinar dedicated to stops. Initial stops, trail stops, what have you. So if you have a swing, a significant swing located closer than 12 ticks, well, then you would adjust it to that. Right. Okay, yeah. Let's go back to this question. Remember over here, we said it has to close above line 2 in a downtrend, right? And stealth, and come into band 3. Now, by definition, these bars did exactly that, right? Close above stealth, the sneaky snake red line, check mark 1. Closing above 2, the thin red line, check mark 2. Comes right into and sits very quite nicely in band 3. We put our region box on it. We put a limit order sell line down here. You can hit market order however you want to get in. You could draw a line or array underneath the bars, and then when it closes beneath it, you get in. By hook or by crook, you're short in here. Yes. Perfect. All right, let's get some different instruments up here. I think everybody understands the fundamentals. That's good. Let's move on. Go ahead and whatever instrument you like to trade and want to see analyzed here this morning. So any of the equities, you want to see YM, the Russell, RTY. See, I got an oil chart up here on the other screen 4. Let's see what else we got cooking today. So here's the Russell chart. What do you want to see? What's next? What's next on the docket? Got YME, got crude, got the Russell. Okay, I see some votes coming in here. I see a couple of YMs. I see a crude. I see a spazzy nazi from Marie. Oh, you want to kick it up in the morning already there, Marie, huh? Breaking the spazzy out. Tell you what, let's see a couple of crudes. Let's get a crude in here. Stand by. Let's get a crude oil up in here. Get to crudey for you crude traders. By the way, if we're looking at a crude chart and you say, well, I don't really trade crude chart, and I can say, well, that's cool, but the methodology is the same, right? So since we're showing trades on crude, it doesn't necessarily mean that those trades are proprietary to crude oil, because the setups are valid on any chart, right? So you really, if you think about it conceptually, no matter what instrument you're looking at, the trading setups are all the same. And that consistency, I think, is what has helped a lot of traders over the years to be successful, because you're going to find from day to day and from week to week, we don't change what we're doing, okay? We've had 4-range charts for, 10 years. We've had these indicators here for a long, many, many, many years. Okay, and that's why a lot of traders come and join up with us and stay for. We have people who have been with us since the day we opened our doors 9 years ago. Truth be told, that's because we're consistent. We don't change. We don't throw a bunch of shamoos at you and say, "Oh, yeah, the RSI did this, but the CCI is doing that, and the MACD is below 50, and the thing is crossing with the thing with the uptrend," and then you sit there saying, What the heck? When that's supposed to get long or short? What kind of trade is that? So you can't be shifting around if you're going to be successful long term in trading. You can't be shifting around or you're going to have serious issues. Now, we're going to do a little exercise on crude. And here's what we're going to do. We're going to test your ability to see trades coming at you in real time. I'm going to do a couple easy ones where in the first couple I'm going to tell you what type of trade to look for. In the next series of them, I'm not going to tell you. I'm just going to advance the chart like we're watching it together, pretending we're recreating Friday morning in real time and the data's coming in. Because one of the complaints we hear all the time is, yeah, there you go, Charles, armchair quarterback sitting all nice and comfy on Saturday morning. It's easy to see these trades. Well, what about in real time when data's flying at you everywhere and bars are going up and they're going down? I don't know what to do. Oh, yeah? Okay. Let's try it. Here we go. You ready? Okay, we're going to recreate Friday morning together. And I'm going to help you on the first one. First couple, I'm actually going to help you. I'm going to tell you what you're looking for. You're going to be looking for a short trade. Okay? And I'm going to advance this chart. It looks like this. And we're going to be pretending together that we're looking at it in real time. And when you see a trade, a short trade, you type in an S. Okay? Here we go. We're going to start right now. We're going to do this trade together. We're going to do a trade together. Let me blow up the bars real quick here. Hold on. Okay, this would have been about 9 o'clock on Friday morning. You're watching the market. You can obviously see it's in a downtrend, right? It's in a downtrend. That's why I'm helping you. I'm telling you, you're looking for short trades. Okay, I'm going to pause right here. I need to pause right here. I'm going to pause the chart. I can see how this can happen pretty easily. When a market is, you've heard this notion of thrust and retracement. So whenever markets are thrusting, they are going in the direction of the trend. Here's the thrust and the uptrend. You see that, yes? Now, in what I am showing you right now here is what's called the thrust in the downtrend. Now, there is a natural tendency for traders, and this happens to a lot of traders, so don't feel bad about it at all. The thinking goes like this. The market starts to drop. Any market. Could be crude. Could be anything. Could be the Russell. And as the market starts to drop, you become convinced that it's dropping because you see it dropping. And you feel compelled to take a trade when a market is down here. Because you are convinced it's going down. You think it's going to continue to go down. And that you feel like you're going to miss it. Right? So you go into your little bag of tricks and you pull out a market order short right down in here. What's the problem with that? Before I even advance the chart, what would be the problem of shorting a market in the thrusting part of the move? What would be the inherent problem in doing that, you think? It's going to pull back against you and probably in some cases go up and get your stop. So in the beginning part of this webinar, we said that did we say that we were thrust traders? Or did we say we were retracement traders? Did we say we were pullback traders or thrust traders? Thrust traders, also known as breakout traders sometimes, pull the trigger when the market is thrusting. Now look, there are cases where you get a powerful trend and the thing runs 100 tick and you'll get lucky. You buy or sell the thrust and the thing keeps going. You might get lucky. That can occasionally happen, okay? And I can't give you an exact percentage of the time, but in all likelihood, when you pull the trigger, there's going to be some kind of pullback and you're going to feel some heat, right? Let's continue on. Okay, resuming our exercise. Ready? So the reason I paused and said that little bit about thrusting is because some people were typing in S's down here. Okay, this is not the short. This is not where you're shorting it. If you typed in an S in this part of the trade, that was not correct. Just so we're on the record on that. This is the thrust part of the move, and you should not, absolutely not be shorting thrusts. Okay? All right, here we go. We're resuming our exercise of looking for a short. And when you see the short setup, you type in an S. Here we go. Okay, let me blow this up a little bit more. There, the bars are nice and big. Okay, now we're at 9:15 Pacific time. Remember, you're looking for short entries in the downtrend, right? Okay, now we're at 9:16, 9:18, 9:23. All right, got a lot of people in here today. Welcome, people. Some people still just coming in, and that's cool. Here again, this is recorded. We'll send it out to everybody, so don't worry if you came in late or you got to leave early. But I'd say about half of you got this correct. Now, here I'm going to show you something that's going to help you with this a little bit, okay? When you're looking at real-time markets, and let's say that you missed, you're not short from up here, okay? For whatever reason, you just didn't get in. You know this is the thrust part of the move. As long as the market stays underneath stealth and line 2 when looking for shorts, as it did in here and as it did all above here, do we need, when looking for shorts, when the market remains in a thrusting down type move inside of this box, do we really care what it's doing in regards to our short entry? Now, of course, if you're short from higher levels, you're managing your trail stop here, obviously, and I'm not going to get into that, but you would care about that if you're already short. But if you're not short and you're looking for short entries and it's staying below stealth and line 2 in the short condition, do you really care in regards to your entry? No. So what I'm saying is you don't doze off and go to sleep and read the paper and forget about the market if you're trading it. That's not what I'm saying. What I'm saying is that as long as it stays down here, there is no trade. There's no short trade yet. It's at a minimum got to get up into here. So until bars start coming above here, we cannot, by our definition of our rules, take a short trade. Now, some of you, and I call those early adopters, when these bars start forming right here, typed in an S, and that is correct. This, by definition, was the earliest point where the bars reached a level where it could be considered for a short. Does everybody understand that? This is really important, this concept. It's going to really help you when you're looking at real-time markets. Does everybody understand what I'm showing here? Okay, until it comes, so what I'm saying is, until it comes above this level right here, in terms of actually looking for and taking a short, it doesn't matter because you've not met the minimum criteria to get in. Well, Ron is asking, are there cases where if it kisses above stealth and line 2, could you take the trade? Now, in very powerful moves, and I say this with caution. Here's an example right here where, technically speaking, it just kissed and broke stealth and line 2 just by like almost the less than a body of a candle. That's right on the borderline. What you're going to have to do in this case is experiment with the instrument that you trade. All right. If it's like a crude oil where you've traded crude oil for some time, you're familiar with the instrument, you watched moves all day long for weeks or months or whatever, and you know that when you get these shallow retracements in a trend that 80-90% of the time they're going to work out, then yeah, go ahead and take them. Now, on the other hand, if you have an instrument that's whippy like NASDAQ, and you find that it takes a shallow retrace, bips down 4 ticks, and then blammo in your face, well, then the answer is no. So it's a function of the trend that you're in, the depth of retracement, and the instrument you're trading. Okay. But yes, everybody who typed in an S for short over here was correct. This is exactly in real time where the short set up. Okay. Now, if you notice today, I'm not spending a lot of time talking about follow through and initial stops and how we manage these is we'll put a region box on. You can put a limit order in. If you put a region box on, everybody knows that your initial stops by default are 12 ticks above the entry. Up here on the short, we generally take a scalp trade off the table if you're trading 2-lot at 6 or 8 ticks. We take the remaining contracts. If you're trading 2, that would be 1. The initial stop comes from 12 down to 2 ticks behind your entry, and then we manage the trail stop accordingly. Okay, so I'm not going to go into that on every single trade. That's the methodology by which we get in and manage the stops and trades, okay? So that's just kind of, we'll cover more of that next Thursday. All right, good. Let's do one that's a little tougher. Let's do a real-time one together where it's not going to be so easy, and I'm not going to tell you the direction, okay? I'm not going to tell you the direction, and I'm not going to give you any hints. I'm just going to advance the chart, and when you see a trade, you type in a T. Okay? So they're going to get tougher from here. They're not going to get any easier because markets just aren't. I mean, some days like Friday when the trends were so clear and smooth and retracements were beautiful and nice and everything was good. Everybody's a genius in a trend. Right? You've heard that saying before, right? Everybody's a genius in a trend. But, when things are shaking around, it's a lot tougher. Okay, everybody ready? Okay, one more crude, and then we're going to go to another instrument. Now, here again, I'm not going to tell you. I'm just going to advance this chart. You type in a T when you think you see a trade. You don't have to say long or short. Okay, you don't have to say. We're going to do this together. We're going to do quite a few of these so you really get a sense of what's going on. Ready? Here we go. So if you're just coming in, what we're doing is an exercise together where we're advancing the crude oil chart. This would have been 7:40-ish on Friday morning. We're looking at the market together, and we're looking for trade setups in real time. As I advance the chart, when you think you see a trade, you type in a T. Here we go. Okay, there's 749, 750. Blow the chart up a little bit. 752, 753, just before 8 o'clock, 754, 755, 756, 757, 758, 7:59, coming up on 8 a.m. Pacific time. Bars are coming in real time. There's right at 8 o'clock. All right, let me stop. All right. A small percentage of you got this, and that's okay. That's why I did it this way. I'm not going to make these any easier. Right? The softballs were already tossed out earlier, so this is the hard balls coming a little faster at you. Okay, let's just recap what's set up here. I think one person in here, and I'm not going to name any names, typed in a T for a trade when the market was up here. Okay, you might have come in late, and that's okay, but this is the thrust part of the move. Notice how we break these swing levels. All these swing levels are broken, and the background turns green. So we clearly have gone into an uptrend. So just to explain things quickly, we don't buy and sell thrust trades. So getting up in here, buying up in here is a no-no according to our rules. Okay, we don't buy and sell thrusts. We are retracement traders. Now that the trend has been established as to up, we are looking for retracements into support to buy, to get long. And so, as long as the market stays above stealth and line 6, the green thin line, so stealth is the sneaky snake line, and green thin line is line 6, as long as the market is up here, Is it eligible for a long trade, yes or no? As long as the market remains above stealth in line 6, as it was in this box, and it was in all these bars that thrust up to create the uptrend, should you be considering trades in this area right here? And the answer, of course, is no, because this is still part of the thrusting part of the move, yes? You're still thrusting here. You have not retraced. By definition, you have not retraced yet. And the reason for that, just to take just a second to explain our logic in approaching it this way, is that if you look at this level right here, and you look at all these bars that have just slightly pulled back off of 68.52, and here, these bars right here, what is the if you were to take a long trade here, just hypothetically, not that you would and you shouldn't, but if you did, if you took a trade here and you were filled on this bar right here, or even if you got in on one of these bars, what is the distance between your entry and the swing level here? Not much. That's right, Thomas, Kathy. There's not enough meat on the bone. Meat on the bone meaning you have to have some distance that the bars can travel from where you're getting in to your expectation of where you think it's going to go. Now, notice these bars in here drop below stealth and close below line 6, the thin green line, check mark 1, check mark 2. It begins on this bar right here. In fact, you early adopters in the room here today started to type in a T when this bar formed and closed right here, and you were correct. That is the earliest, this bar right here is the earliest indication that you have sufficient depth of retracement to even consider taking a trade. You were further convinced, and more T's came in as these bars formed right here, and you were correct. Everybody who typed in T's when these bars were forming, and you can't say that you didn't have enough time to do it. You can't say that because this bar started forming on 7:54 and change. And if you recall, I was calling out the time as they formed, and this bar over here formed at 8 o'clock. How long did it take for this box to set up? 6 minutes. 6 minutes. Was 6 minutes enough time to put a box in here and take a trade? I mean, you could have gone out and had a Snickers bar, put the box on and still take the trade. You could have made a cup of coffee and had a ham sandwich. What I'm trying to say to you is I think that a lot of times what I see in talking with traders is that if there's a sense of panic, you feel like, I don't have any time to get in. I can't think about this. Oh, I'm so stressed. And then you get all wigged out and it's hard to take a trade. No, calm down. I mean, there are times when, this bar can sit there for 8 minutes. You might get tired sitting there waiting for the thing to break up. Now, in this case of this box, you are taking long trades only because it's an uptrend, no short trades. Why would you not want short trades on a region box located here? Why no short trades here? Well, there's lots of reasons, but what would be one of the main ones? And I'll help you out by drawing a couple of things here for you real quick. What am I showing right there? Why no shorties? Oh, the trend is up, obviously, because of deeper retracement. Exactly. That's exactly right. Now, you may have bars that come down into here. You may have bars that go all the way down into here. And if you enabled short on that box, you could be sucked into a short you don't want to and have to stop out of it only to then go re-enter and take a long. Does everybody see that? Now let's go back to our earlier question. In the depth of retracement, can you see that the depth of retracement from here to the top of resistance, the swing, and if it went all the way to midband? So what we're saying then, we're saying that by definition, if you close below stealth in line 6 in the case of the up trade taking the long and get into this band here or deeper into the midband territory, the reason we have defined it that way, if you're ever wondering why you have all these silly rules, is because you can see that there's plenty of meat on the bone to get back to resistance. In most cases, this will be at least 20 ticks. Let's go ahead and measure it real quick. It came to the mid-band at 28.30. Let's call it 30 for a round number. To get back to 52 is how many ticks from a mid-band trade to our swing? And that happens a lot. If you watch these markets, mid-band to swing is you at least get to line 6 most of the time, and that's at least 10 ticks. And oftentimes you'll get to the swing and take it out like you did right here. You take it out and it keeps going. That's 22 ticks. In this case right here, you got your bounce at 39.40, and you're already up here at 62. This is 20 ticks. This is 22 tick trade right here. That doesn't look like much, but remember, crude's a $10 tick instrument. That trade on one lot is $220. Two lot, $440. You could have been asleep all morning. You could have slept in until 7:30. Woke up, wiped the sleep from your eyes, put up a crude oil chart, watched it come down here, sit in this box for 6 minutes, draw it, put two lot on, and from here to here, in less than 10 minutes, make $440. I mean, I doesn't get any better than that. I mean, I'm not saying, but some days the markets almost literally hand you money if you know what you're doing. Okay? Not every day. There's choppy days. I'll give you that. There's some days where it doesn't retrace quite nicely or it doesn't respect swings. That occasionally happens. But if you know what you're doing, you be patient and you watch the market, pull the trigger at the proper time for the entries, manage your trade correctly, and you can make some good money, some serious money. Let's see where this run actually stopped. Let's say you got filled on here, what do we say, 39.40-ish? Maybe you didn't get stopped out all the way up here until 62, 63. 24 ticks, 240 a contract. Just one trade. Forget about everything else I've shown. Forget about all that. Just that one trade right there. Two lot, what would that be? Almost $500. How many of you would like to make $500 a day trading, and do it on one trade? I would. I'd be putting my hand up. Where do I sign up for that? Anyway. All right. Okay, good. Okay, let's see. What else do we want to cover here? I want to do it and then do it 10 more times. There you go. All right. Okay, what else did people want to see? I think we saw some YM's hands were shown. Let's get the YME chart down here. I mean, that happens in markets all day long. It really does. I mean, I'm not trying to be facetious about it or flippant about it. Let's show an example. I think this is a healthy exercise before we wrap. Hold on a second. Just stand by 1 second, please. Okay, now let's look at a chart where maybe a mid-band trade would not be such a good idea. And I'm going to do this in real time. I'm going to advance this chart on YM, and this is going to be at 9:30 on Friday morning. And you tell me whether you think that there's a mid-band trade by indicating with a yes that there are mid-band trades, or no, there's not mid-band trades and is an area that should be avoided. So this is a yes or no question. Okay? It's 9:26 on YM on Friday morning. Now I'm going to advance the chart. Hold off. I'm just going to advance the chart. And as you watch it, you type in yes, you would take mid-band trades, and no, you would not take mid-band trades. Here we go together. 9:28, 9:30, 9:35, 9:49. Remember, if you think you see mid-band trades, you type in yes, I would take mid. You don't have to say long or short. You don't have to indicate the direction you would take it. If you don't think it's appropriate to trade a mid-band trade, then you would type in an N for no. 9:55, 10:05, Okay, I'm going to stop right there. Most of you didn't answer this question. There might have been a little confusion. How would you know in real time that you were in chop at the midband and it would be an area to avoid? As far back as way over here. What little exercise do we do to know that we're in a tight range? Well, how do we know? What physically can you do to this chart to help you visually see whether you are in a range or not? This is something that we preach all the time. We preached for years and years and years. All of our successful traders that are with us that make money do this exercise every day. It's very important in your regimen of trading. You put lines at swing levels, very simply. You take your horizontal line like this, and clearly you can see that as this was forming, that you can put a line right here. Yes? More or less around, close to line 2. You could put another line here, like such. There's a swing there, yes? And you would have known this as early as 926 or 928. And, well, you could put another one down here if you wanted to, and there, and then you could put another one if you wanted to, up here. Now, the reason we do this exercise, and I strongly urge everybody who, gets our system and trades it and looks at these bars and these setups like this to actively put lines on charts. That's why you see them in the live trading room. You see them in the live trading room for this reason. It defines where support and resistance are. It helps you make decisions in terms of trading. And perhaps more importantly, it identifies areas you might want to stay out of. Now, let's advance the chart again with the lines on it. Same exercise we just did a minute ago, only now we have lines. Okay, you can see that support is holding. You can see that resistance is holding. Now there's lower resistance at the midband. And let me just make it clear in a couple of different ways. As long as you are within the confines of these lines, you are said to be range bound. Now, how much distance is there between the midband and the top of that range? Well, the midband sits at 43, and the top of the range is at 50, 52, 53. This is like 10, 11 ticks. How about between the midband and 43 and support here at 30, 31, 32? 10, 11 ticks. By the time you were to enter a trade on a closed bar up or down and put a little bit of slippage and commission in, is there any meat on the bone to take a trade here or to take a trade here? Yes or no? Which is answering the question on whether you should trade that area. And the obvious answer is, of course, no. By the time you get in and out of that, the only person making money is your broker. So what I'm saying, just to be clear, is that when you see a tight, range-bound, choppy market bounded by close resistance and support just above and right around the midband, as you see right here, this area you should absolutely avoid and not take any trades at all. And the lines, please, 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 a million times, please draw the lines, and it will help you see that. Stand aside. You have to wait. The market will eventually break. It will. It'll break up. It'll pull back. It'll give you some long trades, right? It'll break down. It'll pull back, and you'll get some short trade entries. But when you're chopping around in here, and you're fighting the fight, the only person making money is your broker. Yeah, this is a big, juicy no. No, no, no. Put your lines on there. Notice also you have yellow bars, and so that's an area to avoid. Okay, good. Everybody got that. Let's get one more different chart up here. We're almost out of time. Let's get the Russell up here real quick, okay? I know a lot of you like the Russell. I love the Russell most days. The Russell is a go-to trade for me. I mean, a go-to instrument. Although sometimes it's you know how instruments are, right? They get their little moody thing. Sometimes they get issues, and it has to be avoided. Other times you get some big runs. You want to do another trade exercise together? You like those? I usually get pretty good feedback on those. Want to do another trade exercise before we wrap? You want a tricky one? Yes? You want a tricky one? All right. I hear calls for tricky ones. All right. You want tricky. I'm going to get a tricky Russell trade here. Been lobbing up softballs all day long. You've been nailing them out of the park, hitting home runs. No mas. You're going to get a 95-mile-an-hour smoker right down the pike. You ready? Last trade of the morning coming at you. Get your spidey sense up. Here it comes. I'm not going to tell you what direction, and I'm not going to help you show you where. Well, eventually, when it's over, I'll show you where to get in. You type in a T when you think you see a trade on Russell. Ready? Here we go. Starting right now. I'm going to advance the chart. Oops, where's my cursor? There we go. Okay, here we go. Excuse me. Hold on. All right, sorry about that. Here we go. Okay, just to orient you here, you are 9 a.m. Pacific time on the Russell chart, $5 a tick, December contract. And you're typing in a T when you believe that you see a trade setup. You don't have to say what direction, just a simple T. Here we go. 901. 902. 904. 905. 906. 908. Let's blow the bars up real big so everybody can see them. 910. 913. 914. 915. 916. 917. 922. All right, let me stop there. Now, interesting. In the responses that came in, and I'm going to talk them and let me address them sequentially. Now, the first trade adopters came in when these bars started to form right here, and that was correct because our minimum criteria is close above stealth, check mark 1, close above line 2, the thin red line, check mark 2. Bars are closing above that in band 3, check mark yes. Then a handful of you typed in T for trade, and of course it would have been short because you're in a downtrend, right? When these bars formed right here, and that is also correct, this meets the criteria of a mid-band trade, right? Where you are taking a trade within the bands just above and below the mid-band itself, the thick line right here. And then a handful of you actually typed in T's when it kissed line 6 and rolled over up here, and that was also correct. So there were 3, by our rules and definition, possible long entry spots. Now, it's quite possible that if you drew the box as I have shown here, with short only enabled, that you never got filled, right? It never breached the bottom. The wick of that candle, nothing filled you short here. If you reboxed it here, you had the same condition. It never broke below. And this is why in cases like this, in a powerful downtrend, that for boxes like these, you only enable the short. Because you can see if you had enabled the long, that the close of one of these bars right here and even the bar right there could have actually gotten you long, which you didn't want. You are still in a short condition here, right? Now, with the kiss of this bar here in the roll, this was the first opportunity for you to actually been filled short out of a region box right here on that bar right there. The close of that bar would have been short if you boxed as I have shown at line 6, which is still a legitimate short trade, right? Now, there was another pause on the market right in here where you had a small collection of bars resit on the midband, and that was your fourth opportunity to get short, which would have been filled short on the close of this bar right here. So, no fill on this bar, box 1, no fill on this box 2, fill on box 3, fill on box 4, and you are short from either of these positions here. So let's look at how much this trade would have made, approximately. If you were filled from here, from 27.20 on 2 lot, and you got taken out at 23.80, that's 27 to 30 ticks, roughly 35 ticks. With a 2 lot, that'd be $350, 300, 3.5. And from here, you're looking at I don't know, round number. What's this? Let's call it 26-ish. And you get stop dive at 23 and change, 20 ticks. Okay, so this was about 20 ticks. This was closer to 30, 35 ticks, roughly, these two trades. This one on a 2 lot would have made around 2.25, maybe, something like that, less commission. Yeah, Kathy, we get that question a lot. The thing that I think makes these deeper retracements, in some cases, you'll hear phantom referred to as a phantom trade, or a deep probe or a deep retracement, where the bars go above midband. And a lot of traders find this very challenging for a couple of reasons. Visually, it becomes tough to take a short because the bars are blue. Okay. And I understand that. I mean, that is, and if you find that taking the trade when it goes that far with blue bars and a downtrend is a problem, then what you can do is simply wait for the bars to come back to the midband here. This was the secondary entry after it rolled. Okay, but until what I'm trying to say here is that this is not a trend change. Everybody sees that, right? It's simply a deeper retracement probe in the down direction. The direction remained to be short for down in a downtrend. Even though the bars turn blue, you almost have to kind of, in situations like that, sort of turn a blind eye to the color of the bar, because we're really trading price action itself. The color of the bar, truth be told, in a strong trend like this is irrelevant. That's probably a better way to put it. I'm not saying just completely ignore bar colors, but in cases where the market's trending and you're looking to get in, price action and swing levels rule the day, not bar colors, right? Well, David, I can see with insights of why you would take the boxes so large and have the candles closing lower. Well, yeah, that's how we box it. We would box it just like we have shown there, David. Yeah. I think what he's saying is, if I'm interpreting his question correctly, is would you have drawn a box that might look like that and actually been filled here? No. You got to. In the case of this box here, you had to close. You got to close below line 2 to get short, right? And when you go kiss the midband here like this, you have to close below the top of 1, 2, 3, band 3. Right here. The boxes would be drawn just as I have shown right here. You see that, David? That's a good question, though. All right, good. Okay, cool. Well, that's a wrap. Let me stop the recorder. Thank you for coming, everybody. This was a great turnout. Fantastic Saturday morning. It's